Welcome to this video on interest rate risk, which is intended for those involved in the asset liability management function, including personnel and members of a bank's asset liability committee. In this video, we'll touch on rate change assumptions, including magnitude, timing, and yield curve changes. We'll then discuss prepayment assumptions and how sensitivity analyses are conducted.
Rate change assumptions used in interest rate risk modeling are vital to capturing the bank's exposure to interest rate risk, including understanding the potential effect of low probability but high impact events. This is so bank management can make contingency plans and take mitigating steps to protect the sustainability of earnings. Therefore, it's important that modeling includes scenarios of sufficient magnitude that capture material changes in cash flow and fair value that may be triggered by such an unlikely event.
To illustrate this concept, let's look at short-term rates over the last 60 years or so. There were many periods when short-term rates changed significantly and in a relatively compressed time frame. In about 1/3 of the years, the federal funds rate changed 200 basis points or more in a year's time. And in a 2-month period in early 1980, the federal funds rate rose 635 basis points. This indicates that modeling for rate changes beyond 200 basis points may be necessary.
In addition to the magnitude of rate change, the timing of the rate change needs to be considered. Depending on the bank's interest rate risk profile and current level of rates relative to the normal rate cycle and monetary policy, the bank may consider instantaneous rate shock scenarios and scenarios reflecting a gradual change in interest rates. In any event, the types of scenarios chosen for modeling would need to be considered against the existing rate environment. For example, in a low-rate environment, scenarios involving significant declines in rates could be de-emphasized in favor of increasing the number of rising rate scenarios. Performing more extreme rate shocks provides useful insight to risk managers about on- and off-balance sheet exposures.
The final aspect of rate change assumptions we'll discuss is yield curve shifts. The yield curve plots interest rates along the maturity spectrum. The slope and shape can shift dramatically over time. Also, long-term rates can move independently from short-term rates in a non-parallel fashion. While upward-sloping yield curves can produce healthy net interest margins as a result of the wide spread between funding costs and asset yields, unexpected shifts can impact these results. The solid brown line depicts a hypothetical yield curve as of the first quarter of year 1 of our measurement period. By the first quarter of year 3, the curve has flattened and severely compressed. Non-complex interest rate risk models usually assume that all rates along the yield curve change by the same magnitude. However, this typically does not occur.
The dotted brown line represents what the yield curve would have looked like had rates moved in a parallel fashion. Had a bank modeled only parallel changes, model results would not have captured the significant impact to the net interest margin in a flattening yield curve scenario. This is why effective banks model changes to the slope and shape of the yield curve, particularly for changes that are unfavorable to the bank, such as a flattened or inverted yield curve.
Let's now review another important assumption factor, prepayment estimates. Prepayment estimates for loans and securities are critical because the receipt of cash flows may occur more quickly or more slowly than expected. The precise timing of cash flows, which determines the value of the asset, is uncertain. Market rates are important to estimating prepayment trends. Prepayments continually fluctuate based on market rates and credit conditions. Mortgages are a prime example of assets with this form of embedded option risk. As market rates decline, prepayment speeds accelerate as borrowers take advantage of the low rate environment to refinance their mortgages.
Other factors that impact prepayments include underwriting standards, loan size, consumer mobility, and delinquency or foreclosure. The seasoning of a loan also impacts prepayments, as loans that have been on the books for many years or are nearing maturity will tend to stay on the books regardless of rate changes.
There are various sources that a bank can use to develop prepayment assumptions. For single-family mortgage loans, the most common are readily available national market proxies. As an example, large mortgage dealers and government-sponsored enterprises estimate prepayment speeds based on agency mortgage securities. They consider factors such as weighted average coupon, seasoning, loan-to-value, and credit scores. Some banks may rely on third-party prepayment models for assumptions, while others may track internal prepayment data to capture historical experiences of their unique portfolios. Others use a blended approach of a market proxy adjusted to reflect the relationship between the market proxy and the bank's prepayment experience.
Regardless of the method chosen, proper aggregation of loans is necessary for effective and appropriate prepayment modeling. When using market proxies, selecting the appropriate proxy is key. When aggregating loans and selecting market proxies for prepayment estimates, banks consider product type, coupon band, maturity, and if applicable, reset dates, indices, and margins. Effective management teams periodically review the market proxies to ensure those selected reflect the bank's portfolio characteristics.
Loan prepayment assumptions can greatly impact the asset or liability's average life, cash flow timing, and fair value. These assumptions are key to income simulation and EVE modeling. Now let's look at an example of this. When rates fall 100 basis points, as shown on the gold line, borrowers are more likely to refinance and prepayment speeds are higher than the stable scenario. As such, the weighted average life is shorter. Alternatively, in rising rate scenarios, when borrowers have less incentive to refinance and prepay, prepayment speeds slow, causing the weighted average life to increase.
In addition to scenario analysis, banks usually conduct sensitivity analyses periodically to help determine which assumptions have the most influence on model results. A common question asked is, how is sensitivity analysis performed?
Sensitivity analysis can be performed by taking the original model, that is, the one that is reviewed by the board, changing a single key assumption, rerunning the model, and reviewing the differences between the two reports. By holding all other model variables and assumptions constant, management can determine both the extent to which the particular assumption influences model results and at what point that exposure becomes potentially excessive. The most effective approach is to analyze each key assumption separately.
Two questions that can be considered when assessing your bank's assumptions include, are different types of rate change scenarios, such as non-parallel yield curve shifts, considered in your measurement system? Are prepayment assumptions reviewed and updated periodically? Remember, the most appropriate assumptions are supported and updated. For estimated rate changes, the model factors in a sufficient magnitude of changes, considers the timing of changes, and estimates how the yield curve may shift. Prepayment estimates are based on proper data aggregation and proxies. Finally, modeling efforts include sensitivity testing to ensure that management focuses on the assumptions that are most influential to model results.
As we conclude, we'd like to remind you that the FDIC has additional videos and resources that can be found on the Banker Resource Center at www.fdic.gov. If you need additional information or have questions or comments, please contact your bank's case manager or email the FDIC at supervision@fdic.gov. Thank you for viewing this video. We hope you found it both useful and informative.